When we created Alignvest, our partners pooled $230 million to invest in our platforms. We wanted to create investment platforms that invest like the best institutions in the country. We created a global cross-asset class platform, and we created a domestic equities long-short platform. That's how the big institutions invest, and that's how we wanted to invest. Then we ensured we had alignment. We locked up our capital for the long term so that we were there with our investors, and we pay the same fees as our investors. That's important to us to create alignment. We want partners to be with us in our platforms as clients. So we're really excited about the quality of our teams. Our global cross-asset class platform is run by Don Raymond and Marlene Puffer. Don built the institutional investing process at CPPIB, and Marlene has been a leader at the Healthcare of Ontario Pension Plan for many years. These are two of the best institutional investors in the world. With respect to our domestic long-short equities platform, that platform is run by Jeff and Reno. They've run one of the largest pools of long-short capital in the country, and quite frankly, I believe they are some of the best short investors in the country.
Canadians have told us that they wish they could invest their long-term assets similar to the most sophisticated pension plans and endowments. The reality is that they're typically invested in a simple asset mix, 60% equities, 40% fixed income. Best practice is to diversify globally into alternative assets and strategies. We've designed the Alignvest Strategic Partners Fund to implement battle-tested best practices in a way that's suitable for Canadian individuals and mid-market institutions. Our approach is global, with an emphasis on alternatives and non-traditional investments, with active strategies that offer many more sources of return. Our approach to risk management is not only best in class, but it's integral to our investment approach. 60-40 has been an effective strategy for the past 35 years since interest rates peaked, but it's unlikely to meet investor objectives in the future. Because equity prices are high and interest rates are low, global thought leaders believe that 60-40 is only going to deliver about half its historical return over the coming decade. This is a really big gap to fill. The Alignvest Strategic Partners Fund is designed to fill this gap through diversified sources of return that we implement in a very cost-effective and efficient way. Our fund begins with a thoughtful strategic asset mix designed to achieve a return of 7 to 10% with moderate volatility. We add value both across and within asset classes using a variety of active strategies. The fund invests in global equities and fixed income in both the public and private markets. We emphasize alternative assets like real estate and infrastructure and alternative strategies, which include long-short strategies and other skill-based approaches. Within this last bucket, we include the Alignvest long-short strategy that focuses on the attractive subsectors in the Canadian equity market. We're really excited to offer this high-caliber product to bridge the gap between what Canadian investors typically do and what the most sophisticated pension funds and endowments actually do. Based on our team's extensive institutional experience, we've carefully designed the Alignvest Strategic Partners Fund to be an excellent complement to more traditional Canadian investment portfolios.
When we first began researching how best to design the Alignvest Strategic Partners Fund portfolio, there were two aspects of the typical Canadian investor's portfolio that caught our attention. First, they tended to lack global diversification. And global diversification is important because it reduces risk. It reduces risk by country, but also by sector, because the Canadian market tends to be very concentrated in a few sectors. The second thing that caught our attention was that they tended to have limited exposure to alternative asset classes and strategies, things like real estate, infrastructure, and hedge funds. And these asset classes and strategies are becoming an increasingly important part of large institutional investors' portfolios because they have a higher expected return and can be very diversifying relative to a traditional stock and bond portfolio. As a result, we had three design goals for the Alignvest Strategic Partners Fund. Firstly, the portfolio would be globally diversified to offset the home bias we see in typical Canadian investors' portfolios, while at the same time hedging a significant portion of their foreign currency risk to manage the overall volatility of the portfolio. Secondly, we'd have an intentional overweight to alternative assets and strategies to compensate for the underweight we typically see. And thirdly, to bring the best of Alignvest, our best thinking, our best portfolio design, and our best active strategies. We are building and managing the portfolio using what's called a hybrid internal-external approach, which is common amongst large institutional investors like the CPP Investment Board and the Harvard Endowment. Our internal teams are focused on the broad asset allocation and tactical shifts using proprietary valuation models, as well as internal stock selection in Canadian equities, where we believe we have a real competitive advantage. We complement all of this with best-in-breed external managers to expand the range of value-added active strategies. Here, we like focused and concentrated strategies operating in less efficient markets. We like managers to be concentrated because we feel that aligns them with good value creation, and we take care of the diversification at the level of the overall portfolio.
Our goal with external manager investing is to identify skill-based strategies that meet our fairly lofty return objectives with acceptable risk. These strategies also have to be only partially correlated to traditional asset classes. We look at hundreds of managers each year on a global basis who are engaged in specialized investment strategies. These are strategies you would typically not find in a traditional portfolio. For instance, we would invest in reinsurance strategies, stock market activism, water rights, or even trade finance. To source our external investments, we do draw on major manager databases, but our most reliable method to tap rare talent is to actually access our extensive personal networks in the alternative investment domain. And these networks have been built up over 2 decades. To identify manager skill is complex. We apply a series of quantitative tests to break down manager returns into their component parts. We need to isolate what is true security selection skill from what might be sector timing capabilities or even mere exposure to certain macro factors. So what do we look for beyond hard quantitative evidence in a manager? Well, our managers tend to have the following 3 characteristics. They're typically very focused on their particular market niche or asset class and have built up immense expertise in that area. They also very often are concentrated and have constructed portfolios of their very best ideas. And finally, in every instance, they are very aligned with us. They have typically invested a lot of their own money alongside ours and yours. And that's how we know that they're seeking to generate the kinds of returns with risk management that we want, and that's because it's also what they want.
Reno and I manage a value-oriented, fundamentally driven equity long-short strategy. The best opportunity for success in a strategy like ours is to focus on an investment universe that's inherently inefficient. For us, that's the Canadian mid-cap non-resource equity space. If you think about the Canadian equity market, there tends to be 2 areas that dominate investor attention. Large caps, the 100 largest companies in the index, that are really the focus of the very large institutions that control most of the capital within Canada. And then the resource sector, which tends to be the focus of more speculative domestic capital and foreign investors who are coming to Canada to express a view on commodity prices. That sector tends to be very capital intensive, often raising money in the equity markets, and as a result, the investment community devotes a significant amount of attention to it. It's not uncommon, for example, to see a $200 million market cap gold company that has 15 research analysts following it who focus exclusively on the gold sector. If you drill deeper within the market beyond those 2 areas, there's actually a proliferation of mid-cap companies with limited institutional ownership and following, little or no research coverage, and a relatively low media profile, which tend to combine to create the kinds of inefficiencies and mispricings that are the cornerstone of our approach.
The Canadian mid-cap non-resource universe in which our strategy primarily invests tends to trade with incredibly low correlation, making it attractive for the long-short component within Alignvest Strategic Partners Fund that Jeff and I manage. The businesses are all very different with different operating environments, different underlying economics, and different cash flow profiles. The only thing they really have in common is their market capitalization. We look to go long businesses with high returns on capital, generate significant free cash flow, and can increase their payouts to us as shareholders in the form of higher dividends and share buybacks. Against that, we're short those businesses undergoing negative change, and the market has yet to fully recognize the negative impact that change will have on the business's cash flow and fundamentals, resulting in a meaningful revaluation of the business to the downside, providing a profit on our short position.